Welcome to Part 3, Video 1 has, of our Sept 814 recap. In this first half, we'll cover the big policy shifts shaping your wallet. US tariffs and EV credits, plus the UK's financial regulation moves and tax chatter. Corporate moves and cultural money trends will follow in Video 2. US policy, tariff changes and tax credit. Cliffs. A couple of under-the-radar but important policy changes in the US are set to hit consumers' wallets, and they were highlighted this week. First up, online shopping just got more expensive for many foreign goods. The Trump administration has been continuing its trade policy moves, and as of the beginning of this month, Sept 1, they ended what's called the de minimis tariff exemption for imported consumer goods under $800. This sounds wonky, but here's the gist. Previously, if you bought cheap items from foreign sellers, think those ultra-cheap fashion or gadget sites like Shein or Temu, popular apps that ship directly from China, packages under $800 could come in duty-free. That exemption has now been closed for many countries, especially targeting China. What does that mean? All those low-cost online purchases from abroad now face tariffs of 10% up to 40% depending on the category of good. These tariffs are basically import taxes that the seller or shipper will pass on to you, the consumer, via higher prices. Already, reports show that Shein and Temu have raised their prices on many items to account for the new fees. And not only that, some international mail carriers, in over 24 countries, have temporarily suspended shipments to the US while they figure out the new customs rules. So your overseas online orders might also see delivery delays or disruptions. This policy change is significant because it primarily affects bargain shoppers and lower-income households who rely on those platforms for affordable goods. When t-shirts that used to cost $5 suddenly cost $6, that difference adds up when you're on a tight budget. The administration's goal here is to close a loophole that big e-commerce players exploited, and to levy tariffs to encourage buying American-made, as well as to collect revenue. But the direct effect is a broad-based price increase on a wide array of inexpensive imports, from clothes to knickknacks. It kind of flew under the radar compared to, say, big tariffs on steel or large goods, but it definitely impacts personal finances. So, heads up. If you're a frequent Temu, Shein, AliExpress shopper, you might need to budget a bit more for those hauls or find alternatives. Also, keep an eye on shipping news. The USPS and others might institute new processes, like collecting tariff payments COD or through apps, that could complicate your shopping routine. Next, the EV tax credit sunset. You might recall that for the last couple of years, the US government has been offering generous tax credits for electric vehicle purchases. $7,500 for a new EV, and $4,000 for a used EV, subject to various conditions. These were part of an initiative to spur electric car adoption and tied into last year's big climate bill, ironically named by Trump as the One Big Beautiful Bill in some communications, though that moniker is a bit tongue-in-cheek. Well, this week it was flagged that these credits are expiring at the end of this month, September 30th, for many vehicles. Essentially, some changes in legislation are phasing out certain credits earlier than expected. The result? If you're in the market for an electric car and want that sweet tax rebate, you need to act literally now, in September. To qualify, buyers must at least have a binding purchase agreement and make a down payment by Sept 30, even if the car is delivered later. After that deadline, a lot of EVs that were eligible will no longer get the federal incentive, or the incentives will be significantly reduced or changed under new rules focusing on American-made batteries and such. The looming cutoff has both consumers and dealers in a flurry. Expect EV dealerships to really push buy before it's gone deals this month. If you manage to snag the credit, that's $7,500 off your tax bill next April for new EVs, which is huge. It effectively lowers the purchase price substantially. Without it, affording an EV might be harder, especially since interest rates on car loans are high right now. On top of that, tariffs, again with tariffs, on imported EV components are expected to raise vehicle costs by a few $1,000s. J.D. Power estimates tariffs could add an average $4,000 to an EV's cost. Manufacturers ate some of that cost increase initially, but they can't do that indefinitely. So the affordability double whammy is coming. Credits gone, plus tariffs adding cost equal higher effective prices for electric cars going forward. In short, if you're an eco-minded driver, or just someone looking to save on fuel long-term, the landscape is changing. Now is the time to buy, experts are saying. After this month, it'll be tougher to find such deals on EVs, and you might be paying more due to trade policies. It's a fascinating intersection of climate policy meets trade policy meets personal finance. The government is essentially pulling back consumer subsidies for EVs sooner than many expected, while simultaneously its trade stance is raising costs. This could slow down EV adoption, or at least shift the market, perhaps benefiting models that still qualify for some new form of credit if they meet domestic sourcing rules, etc. For individuals, the takeaway is, if you were considering going electric, run, don't walk, to do your research immediately. And if you miss the window, you'll have to recalc the math on whether an EV still saves you money in the long run, factoring no tax credit but still cheaper fuel, electricity, and maintenance than a gas car. On a broader U.S. policy note, the week also saw lots of election season posturing on fiscal matters. While not a single policy event, it's worth noting that President Trump and the Republican-controlled House are talking about budget cuts and possible government shutdown theatrics, as mentioned in markets. Meanwhile, on the Democratic side, there's buzz about pushing for middle-class tax cuts or renewed child tax credits to help families, but nothing concrete passed this week. Just know that the fiscal debate is heating up, which could mean changes to taxes or benefits in the next year, but that's speculation for now. One more U.S. regulatory tidbit. The Consumer Financial Protection Bureau, CFPB, has been relatively quiet this week in terms of major new rules, but it's been focusing on things like junk fees and data privacy in finance. For example, they've proposed rule changes to make it easier for consumers to switch banks or take their financial data with them. Open banking stuff. Also, there's ongoing talk of new rules for credit reporting and for Buy Now, Pay Later, BNPL services, to ensure consumers are protected. While not resolved this week, these are things in the pipeline that we keep an eye on, as they can impact how you manage your money, e.g., maybe easier to compare bank fees, or BNPL firms having to be more transparent about costs. UK policy and regulation, financial system overhaul and tax talk. On the UK side, one interesting development was a consultation launched by HM Treasury on Sept 8 proposing to merge the Payment Systems Regulator, PSR, into the Financial Conduct Authority, FCA. This might sound like regulatory plumbing, but it has practical implications. The PSR is currently a separate body overseeing payment systems, like the networks behind your debit, credit card transactions, bank transfers, etc., ensuring they're competitive and fair. Folding it into the FCA, which is the main conduct regulator for financial services, could streamline oversight and possibly make it more efficient to enforce rules on banks and payment firms. For consumers, the potential benefits touted are greater protection and convenience in payments. For instance, more consistent rules on things like contactless payment limits or cracking down on payment fraud with a unified approach. The FCA has been raising the bar on how firms treat consumers via its new consumer duty rules. So bringing payment systems under that umbrella could mean those companies have to prioritize consumer outcomes too. It's early stages, just a consultation paper, so nothing changes immediately. But down the line, it could affect how quickly innovations like new payment apps are rolled out and regulated, or how issues like scams and payment errors are handled. Speaking of payment convenience, the FCA also floated proposals to increase the contactless payment limit for tapping your card or phone. Currently, the contactless single-tap limit is £100, raised during the pandemic. They're considering bumping it higher, which would let people tap to pay for even larger purchases. Great for convenience, though some worry about fraud risk if a lost card is used. That's still under discussion. Not a done deal, but interesting as a cultural shift. The UK has become very tap-happy and largely cashless for everyday transactions. Now the big policy chatter, taxes and budgets. The UK Chancellor announced that the autumn budget will take place on November 26, 2025. That's beyond our week, but what was in our week were swirling rumors about what might be in that budget. One that made headlines, as you noted from the Guardian snippet on Aug 28, was that the Treasury is considering a tax on landlords' rental income, effectively ending or reducing some of the tax breaks landlords get, possibly to raise around $2 billion. The idea mooted was to tax rental income more like regular income. Landlords already pay income tax on rent, but there are allowances and deductibles that could be tightened. If such a policy were implemented, it could have a couple of outcomes. Landlords might attempt to pass on the cost via higher rents, not great for tenants. Or it could deter some buy-to-let investment, which, depending on who you ask, might be good to cool housing prices or bad if it reduces rental supply. It's just a floated idea for now, no official policy yet. But it shows the government is hunting for ways to boost revenues without overtly raising basic rates of tax, since politically they want to claim they're not raising broad taxes. We'll have to see if this makes it into the budget. Renters and landlords alike are watching closely. It's a politically sensitive topic given the housing affordability crisis. Another UK policy angle is the push for economic growth and financial services competitiveness. Earlier this year, the government outlined a 10-year strategy to rewire the financial system post-Brexit, including reforms to listing rules, to attract more IPOs to London, easing insurance solvency rules to free up capital, and so on. This week didn't see a new law or anything, but these efforts are ongoing. The Mansion House reforms from July for pensions to invest more in UK companies, etc., are in consultation phases. If you have a pension, these moves could gradually change where your money is invested. More in UK infrastructure or startups maybe. And if you're an investor, they might open new opportunities on the London stock market. Also worth a note, the UK's energy price cap. While energy prices are lower now, the government is considering how to reform electricity market pricing and has announced some targeted support, like for vulnerable households' winter gas bills. Nothing major this week, but as autumn approaches, energy bills will become a talking point again. The current Ofgem price cap for a typical household is about £1,923 a year as of October, down from over £2,500 last winter thanks to falling wholesale prices, but still higher than pre-2021 norms. Any new government support or lack thereof will impact disposable incomes. We'll keep an ear out. On the regulation front, the FCA's new consumer duty officially came into force for financial firms at the end of July 2025. By this week, firms are under this regime which requires them to act in consumers' best interest proactively. We haven't seen major enforcement actions yet. The FCA is giving some time to adapt, but this could lead to tangible changes, like banks having to make fees clearer, insurers ensuring products offer fair value, etc. Over time, this should benefit consumers. Fewer tricks and traps in financial small print, but firms might also pull some products that they deem unprofitable under the new rules. For example, some banks have already simplified or removed certain accounts. A regulatory consulting newsletter noted that the FCA published some data on whistleblowing. Many tips coming in about culture and mis-selling. So the watchdogs are on alert. One specific consumer issue under UK regulatory eyes, savings rates. Earlier, regulators pressured banks to raise savings account rates in line with BOE hikes, noticing banks were quick to hike loan rates but slow on deposit rates. By now, with base rate at 4%, many easy access accounts pay 3 to 4% and fixed savings 5 to 6%. The FCA has demanded transparency. They forced firms to explain low savings rates. This week we saw the outcome. Competition has improved, with a record number of savings deals as mentioned. But interestingly, average savings rates dipped slightly in September, 3.46% from 3.50%, which could reflect banks anticipating no further BOE hikes and thus trimming rates a bit. Regulators likely will keep pressuring if they think banks are shortchanging savers. Good news, there's a proposal to require banks to give notice to savers when a promotional rate is about to end or if their account is especially poor value, so people can shop around. If implemented, that'd be great. No more silently dropping your rate to near zero hoping you won't notice. International policies impacting personal finance. A quick note on something indirectly relevant. Globally, there's been talk of new bank capital rules, Basel III Endgame, and how they might affect lending. U.S. regulators proposed higher capital requirements on banks to prevent future failures, and that could eventually make loans a tad pricier or harder to get if banks tighten. In the UK, regulators are likewise mindful of stability. While these are big-picture regulatory issues, they trickle down, e.g., if banks have to hold more capital, maybe fewer high-risk mortgages, etc. But nothing immediate this week, just ongoing industry groaning about it. In short, U.S. trade and EV policies could nudge prices higher, while UK regulatory tweaks aim to streamline payments and keep banks fair for consumers. In video 2, we'll jump into the corporate side, banks, fintechs, retailers, tech, housing, insurance, and then zoom out to this week's cultural money shifts and our full week wrap-up.